People have been holding on to a lot of cash recently. And when I say cash, I don't mean dollar bills stuffed into a mattress. I mean putting money into high-yield savings accounts, CDs, or money market funds in order to collect interest while interest rates are high. But as the Fed starts cutting those interest rates, the pendulum could swing again from cash into equities, bonds, or crypto, which could trigger rallies in those markets. The question is, when will this happen, and what does it mean for the stock market? For the last few years, investors have favored cash assets. For example, money market funds have peaked at an all-time high recently. As you may notice, this line started moving up when the Fed began its rate hiking cycle. At the start of 2022, interest rates were pretty close to zero, but in 2023, they reached a high over 5%. That's the highest they've been in almost 15 years. An eToro survey found that cash was the most popular asset among American retail investors. 76% of the people surveyed were holding on to some sort of cash asset. Meanwhile, only about half of the people were holding on to stocks. It's important to keep in mind that this survey was taken in the first half of the year, and since then the Fed has started cutting interest rates. How low do rates have to keep dropping to motivate people to move that money out of cash and put them into investments? Data from the different investing apps may give us a clue. When the interest rates went up, Robinhood thought it would be a good idea to give its premium customers interest on the uninvested cash in customer brokerage accounts. In November 2022, premium Robinhood customers held about $3.9 billion in cash. Roughly a year later, that number increased to $15.7 billion. Meanwhile, that cash balance for customers who weren't getting interest stayed about the same over that year. So Robinhood asked some of its customers why they were holding so much cash in the accounts, and they found that people were still pretty happy holding cash if they got 4.25% interest, but at 3.25%, they started to see a shift in investor behavior as people were more likely to take that money out of cash and invest it. And now the Fed is expected to keep cutting those interest rates, which means the return on cash is going to keep going down. In previous rate-cutting cycles, we've seen stocks outperform cash. In the year after the Fed started cutting interest rates, the average return for stocks was 11%, compared to only 2% for cash. Investors are holding on to this large pool of cash, but lower interest rates might cause that pool to spring a leak, potentially causing a rally in stocks, in crypto, or elsewhere, so investors might want to reassess how much money they're keeping on the sidelines.